It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world. My name is Patrick L. Young. The IPO-VID live stream, Series 19, episode number 4. That makes in the aggregate episode 112 starts here. Almost 5 years after Mr. Ass made a right-einer of himself, NASDAQ has sold its power business to EEX, another coup for the Peter Reitz-run Deutsche Börse subsidiary. It's not material, but it probably helps release NASDAQ CCP capital, just as they're pricing their notes in order to manage to buy Adenza. Meanwhile, MCX stock, that's the multi-commodity exchange of India, has been highly volatile in recent days after they cancelled a Saturday test of their delayed TCS trading system. A mock section took place finally on Sunday instead, helping the stock recover, but investors remain jittery that TCS won't be able to deliver even on their later deadline. Meanwhile, the UK and India are moving closer. In one sense, the UK looks to recognise the Indian CCPs, which ESMA recently repudiated. Meanwhile, even BNP and the Bundesbank are cautioning against the European Union's spurned divorcee attitude towards London euro clearing. With the recognition of the Indian clearing houses, that marks a very definitive move forward for the world's most cosmopolitan multi-currency clearing centre in London, away from the rump Eurozone. And finally, still in India, SEBI have ordered a remarkable punishment for a multiplicity of NSE executives, past and present, who were caught up in recent regulatory problems. SEBI has sent several back to school for re-education. I wonder which exchange executive you'd like to send back to school for re-education, viewers. You can add those comments wherever you're watching this today, on Facebook, LinkedIn, or YouTube in the comments. Don't forget to give us a little bit of love. A like goes a long way to helping the artificial intelligence understand just how useful this content is for the world's traders. And today, our guest, Yra Harris, on the topic Patience is a Virtue. Ira has over 46 years of experience in all areas of commodity trading, with broad expertise in cash currency markets. Ira is an active macro global trend trader. He's a regular guest analyst on all the best currency and global interest markets conversations, including on Bloomberg and CNBC, and multitudes of other podcasts beside, not just IPO-VID. Ira, welcome to the show. Where in the world are you today?
I like Carmen, San Diego, but now I'm in Scottsdale, Arizona.
Scottsdale, Arizona. What a magnificent place. Apart from anything else, home to one of the biggest classic car auctions of the year every January, February. That's the one thing I know about Scottsdale. How long have you been living there?
This is 7 years.
Wow, fantastic. And you moved direct from Chicago?
Yep. After all my whole life in Chicago, picked up stakes. My wife said it's enough for the winters. Let's go to the desert. So here we are in the desert. Love it.
It's comprehensible after all of that time that you've been in the desert that you might be there. Let me just say good evening to Peter Secon. Evening all, says Peter Secon. Hello, Peter. It's lovely to see you on the show today. Thank you very much for being a loyal viewer. Hope Ari is very well and with you on the sofa at this stage of the afternoon. So, Ira, tell us about it. How did you get into financial markets in the first place? Good grief, nearly half a century ago.
Well, I was in graduate school with a very leftist Marxist bent of thinking in political science and political economy, basically. And I started my master's thesis, came on multinational corporations and the way they operate in what we weren't calling it then, but a post-Bretton Woods world. Leo Melamed, in his wisdom, had put currencies into the investment world. And I had learned a lot about currencies through my studying of multinational corporations and the way they operated. And after I left, after my master's, I said, yeah, what do I want to do? I wasn't sure. I was going to go to Washington and work for Frank Church on the subcommittee on multinationals. That disbanded. So I was hanging around, and a good friend of my father's, Lenny Feldman, who was a currency, who is now was a pork belly trader, but moved to currencies, and I had written a paper for him on the German elections in the Deutschmarks in 1975, 76. And he says, wow, you know what you're talking about. I'm going to come work for me. I said, no. He asked me a second time. I said, no. And then he said, well, you're not doing anything. This is the last time I'm asking you. He says, you can go to Washington if you want, but you'll do much better if you come here. So I took him up for it. And to the day he passed away in 2015, when he was 89, he would always tease me going, I thought you were just coming for a weekend. I could never get rid of you. So that's the way I moved into the world of foreign currencies.
So you moved into the world of foreign currency trading, and how did you do that? Were you actually trading then on the floor of the CME's nascent FX complex, or how did it go?
Yes. So I went to work for him, and he taught me trading, and then he opened a currency arbitrage, which was what the plan was. And I was just working for it. And then all of a sudden he comes in, he says, no, you're going to run this whole thing. So as he reminded me to the day he died, I was overpaid at $200 a week, but we soon rectified that. But I learned how arbitrage works. And it was really good because I got to go to Wall Street and other places. And I actually knew a lot about the foreign currency markets, actually more than the people who trade in currencies on the bank desks, because what you find, and even in London, is that they were putting people to currency trading just because they could breathe and they were alive, because the business started to grow so fast, it was way understaffed. So they were taking all the lower end clerks and teaching them to be traders, and they became traders. So,
well, there was also, I mean, London had that incredible snob value element. I mean, it was regarded as really being the province of the East End and Essex wide boys, wasn't it? So therefore, the people who, with any degree, who were bourgeois and more highly educated, they all tended to stick to equities and gilts because they were the more gentlemanly pursuit.
Patrick, it's funny because just this week I was telling somebody who had asked me about that, somebody here where I live, and I said, well, when I used to go to London, it was really hard for a young American to understand how class rigid London was. Because I would sit and we'd go to the pubs after the markets and we would have more than a few pints. And a lot of the traders would tell me that this is the greatest thing that ever happened to them because they got elevated into a life and opportunity that they never would have seen. So they were really great advocates of the markets because they really provided a great opportunity to lift them out of what would have been, as they would tell me over and over again, if you're the son of a coal miner, you're going to be the father of a coal miner. And that's the way things work. But when the financial industry opened up, it opened up in a big way.
Yes, and then it carried on in through the 1980s when the UK adopted the same sort of deregulation that the late Nixon regime had put together, which was enacted under President Ford by the 1st of May 1975. And that caused such a huge big bang in Britain, as they called it, in 1986, and it moved these guys further forward still. So, okay, so you're traveling around, you're learning about the world of foreign currency trading, you're on the floor of the CME, you're running this arbitrage desk and so on. How did that develop for you?
Well, as my mentor and my partner, Lenny, he taught me how to trade because he said, you can be the smartest person in the world, but if you don't know about risk management, you're destined for great failure. And I met a lot of those people, so I would listen very intently when they would teach and willing to teach you about markets. I was lucky to have a lot of people who were willing to teach. I mean, a litany of people who really try. The exchange was a great place for that because if you were willing to learn, they were willing to teach. And there were so many, I'd be remiss because I could name one after another who really took the time. And as I learned that, then I learned to put it together. And I always had because of my work in studying multinational corporations in the 70s, I had learned about global flows. So I understood the concept of flows. And I actually created my own little matrix to try to measure when one thing would impact another and to look for, I've always been a really good spread trader. That's really my strength because and I learned a lot of that from Rich Dennis, who was a master of buying strength and selling weakness in any types of things. But mine was really more honed to types of capital flows, which is still the backbone of my work today. So I knew a lot about global bond markets too, because I studied quite a bit about third world debt, especially in the post 1973 Yom Kippur world and third world debt. And especially coming from a Marxist background, they were really, them and the Austrians really were the most intense students of debt and its effect upon global capital flows.
So is it fair to suggest that as your journey carried on that your Marxism started to waver just a little bit?
Well, it did before that as an activist and actually doing things, going to demonstrations and organizing. And then you started to see that, well, a lot of things you theoretically think just don't hold in the world. And nobody really wants to pay attention to you anyway. You get spat upon, you get, and whatever else comes with it enough. And you say, oh, well, I don't know. And then you start to see markets work. And you go, wow, markets are really a force that you really have to pay a lot more attention to. It's just not political decisions at the top pressing down to get policy actions. A lot of times markets really do work. So and if you're going to be in the markets, you better get respect for the markets, because you will not be there long if you don't respect the ability of markets to cause, as my friend Norbert would say, as much pain and discomfort as they possibly can.
Well, of course, it reminds us all of, what was it, James Carville's comment. He was the notable advisor to Clinton, wasn't he? He wanted to be reincarnated as the bond market because then he could scare everybody. And I think that was a great description. And you're talking too about the invisible hand. And obviously that brings us back to last week's show. We were talking about Adam Smith with the boss of the Adam Smith Institute, which is so interesting. So as the 1970s proceed, I mean, it's interesting. I was not around. I was not trading foreign exchange at the time, but we saw obviously quite a huge explosion in the post-Bretton Woods collapsed foreign exchange market. You're talking about flows, capital flows, and so on. I mean, initially foreign exchange seemed to be moving hugely on the back of just pure trade, but it started to become a lot more sophisticated as the 70s went on and into the 1980s, didn't it?
Oh, it did. And really, it was the genius of Leo Mohammed and Milton Friedman along with him, and people, and those who had enough gumption, if I may use that word, at the CME to sign on to it. And the currency flows became a phenomenally important mechanism. And then, of course, you have the rise of China beginning in the late 70s. And with that, things changed dramatically. And then you get the fall of the Soviet Union. And so that opened up as what we call today, globalization, because you had this whole part, half the world, more than half the world, who had been locked behind, as Churchill would say, the Iron Curtain. And now they wanted to breathe a little bit. And with that, the money started to flow, because what you were really seeing in the classic market Marxist sense was global capitalism being able to arbitrage global wages.
Yeah, and it's quite fascinating because the whole system starts to obviously explode as more and more countries liberalized as well. I mean, that's the thing is, I mean, yes, the US dollar was liberalized in 1971, but you couldn't take more, if I remember correctly, something like £25 out of the UK in cash when you left the country, right through until Mrs. Thatcher took over and actually passed laws against that in 1980. And similarly in France, there were all sorts of currency and capital restrictions. I think it's something that people don't really realize is how relatively recent free-flowing foreign exchange and capital has been, with clearly a few key exceptions to this day, such as, well, the renminbi and the Indian rupee, etc.
Yeah, and probably, we think about, if you go back to the Asian contagion crisis that began in Thailand officially, well, it gets calendared in 1997. But then the answer to it from Malaysia and Mahathir Mohamad was to put on some type of capital controls because the devastation from the currency moves of 97 and 98 were so great. But actually, Mahathir Mohamad, as Prime Minister of Malaysia, he was pretty successful because it was a new type of capital control, which was he basically locked money up for 3 years, so took away the hot money flows that caused so much chaos in that part of the world. So you did start to see him, and you see him a little bit today, where there are some restrictions on him, and you might have to sign on for a longer period of time to keep your money in any of these banks so that you're not just getting pure speculative interest rate arbitrage.
Yes, that's absolutely true. I think also, of course, the thing that was great for Mahathir Mohamad's Malaysia was that fundamentally there was an incredible growth economy there as long as he was able to keep it going. If you compare that to, say, an economy which doesn't have the same degree of growth ethos like Argentina, you have 30 years of absolute hell allied with ongoing capital controls, which just seem to make the situation worse as you go along.
Yeah, you had that, and it's interesting that you bring that up. So if we go back to 2001, 2002, when we had the currency board.
Yes.
So you get the Brazilian devaluation. And I had actually put on a position because I couldn't do it at the floor at ABN AMRO, long the real and short the Argentinian peso. But I couldn't stay with it because Argentina fouled in order to defend the peso and keep the dollar peg. Thank you, Steve Hanke. But they would raise interest rates. So the cost of continue to carry that trade became expensive. The same as what happened in France in the early 1990s after the British decided that it was a grave mistake of 1989. So, of course, it's called the George Soros Bank in the Bank. Yep. But that was 1992. So then the French go do everything they can to protect the franc within the ECU, I think.
Yes, the ERM. Yeah,
right.
Yeah, exactly.
The ERM.
Mm-hmm.
And so Jean-Claude Trichet, who was the president of the Bank of France, he had his Lefort franc policy, and interest rates in France would overnight rates would go to 100%, 110%. If any time the speculators tried to move in and to try to break the French franc. So yes. Interesting times those were.
Fascinating times altogether. And how are things these days? Because obviously we've had this incredible explosion of electronic trading. The floors are dead, digital markets. How has that changed the business for you over the years?
Well, I was being a part of it, and I know a fabulous interview you did with Jimmy Olaf. And I was every bit a part of the transition. I had gotten elected to the board in 97. And I went on the board, especially with Jimmy Olaf, and he was there, but Bill Shepard and a few others who were building on Leo Mohammed's vision about Globex, which had already been 6-7 years in place, but it was ready for the next role. And being in the way that I traded, so I could trade off the floor and I could trade on a Globex platform fairly easily. So I knew the transition was coming. So did I want to be a part of that? Yes. It was good leadership of Jimmy and Jimmy Olaf and Bill Shepard, and taking it where it had to go. So you knew it was changing. So I had geared myself for it, but I had never geared myself for the speed of the algorithms that I really saw beginning to wreak havoc in the way that I had traditionally traded with the way I set stops. So I really, as you note, I became a much more patient trader. And even to this day, I'm still learning how to be a little bit more patient because these electronic methodologies through the use of algorithms really have the ability to wreak havoc at any moment of the day and several times during the day. So I find if I'm patient and I really do my prep and wait for levels that I never think I would see, I see them. So that's what I wait for. And if I don't get the opportunity, I don't get the opportunity. I no longer feel that, as I say, I don't have to tell the markets what they ought to be doing. I will wait for them to tell me.
That's fascinating. So to unpack that, let me just first of all go to, I thank you once again, Peter Secon, saying evening all earlier on. And John T, evening everyone. Good to see you, John T. Thanks so much for joining the show tonight. We're discussing patience as a virtue with Ira Harris, a somewhat legendary trader now located in the wonders of Arizona after many, many years on the floors of the Chicago Mercantile Exchange, etc. So Ira, let's unpack that because I'm really, really interested. I mean, years and years ago, I observed that there was a phenomena in floor trading, which was that quite frequently you would see levels on a Monday and the market seemed to go in one particular direction and you'd never manage to see it coming back. And by Wednesday, it went back there, but none of the locals ever noticed because the locals were all only trading the next tick or the next half hour or the next hour. Explain to me a bit more about how we unpack this issue about the algos, because surely their perspective is microseconds and nanoseconds, is it not?
Well, it is, but I realized about 20 years ago, and even when I was on the board, I used to say, we have to be very aware of this. The algo, there was all of a sudden a proliferation of news services.
Mm-hmm.
You could probably name them better. FX Match. There was just so many.
Yeah.
And they would release headlines, and then the headlines were being read by algos who were looking, and they were I from just sitting in my office and trading, they were searching keywords, and the headlines were being written with keywords, and then we were getting all this volatility. But then you would read the actual news story, which would foul at some point, and the context had nothing to do with the headline.
Right.
And I still believe it goes on. I think it's
Yes.
probably more now than ever. And it searches for words. And I've really never understood how the CFTC or SEC really has not gotten involved. And I know that it becomes a First Amendment issue at some point. But at what point can these machines craft headlines that are based maybe on nuance, but with no context, drive rapid movements in markets, both equities and bonds, all over the place, and then find, well, there's really nothing to that. And so that's why I've become more patient, because I'll actually go sift through the news story. I'll go, wait, that headline had nothing to do with it. What I was thinking about is absolutely still holds, and then I'll establish a position. So I'm not getting stopped out in the ways that I used to. I will sit back and wait, and my prep work therefore has to be so much more. And here this week is actually a good week because we have the central bankers meeting in Sintra, Portugal this week.
Mm-hmm.
So tomorrow at 9:30 Eastern time, there is a panel of, I think, Jerome Powell, Christine Lagarde, the BOJ Ueda, and Andrew Bailey. So, and I'm sure Augustine Carson's, because last year, that same panel, if you paid attention to it, there was some really interesting movements. So I'm going to try to be ahead of this because I'm especially intrigued now with the Japanese yen. To me, the Japanese yen is the most undervalued currency in the world by a lot. Now, now I have to sit and listen to this closely, because is this a part of the policy to reshore out of China? Because, all you hear about, Intel, even some other firms are moving chip manufacturing to Japan. Well, the weak yen enables Japan to be a bulwark of high-tech exports. So I'm watching this very carefully. And is this part of a policy from the G7 per se to allow a weak yen in order to give Japan an advantage to be able to reshore some manufacturing to Japan out of China? So there's a lot of things that work here. So I'm listening very carefully.
That's very, very interesting. And actually, we've got a question just come in here discussing patience as a virtue with Ira Harris this evening. Do you think there are sufficient controls on the algos, particularly with the development of artificial intelligence?
No, I don't, because I think the money is being made by those who write programs and in order to create volatility. The earnings of Citadel et al. Aren't by happenstance. They have figured out something in this that gives them some type of edge. But more importantly, Patrick, and I know when I say this, you'll have an opinion one way or another about it. Most people don't realize that when there's like speeches like from Powell or from Yellen or from others, that they're given to the media 30 minutes before they're released so that they can do their stories. Well, in today's world, I find that to be an archaic practice. Why should they have it? Because the ability to move in nanoseconds, we've never been here. Well, meaning I'm going back to the 70s, 80s, and 90s. You didn't have that type of thing, and there can be all types of games that get played. And everybody should get it at the same time today. There should be no advantage given to the media. I know they go into quarantine or they get sequestered. Not good enough for me. I think there's too many games and there's too many people with press credentials. That's all. I'm not creating conspiracies. I'm just saying there just seems to be a lot of volatility around these and a lot of headlines that to me are very suspect. Let everybody get it at the same time. And that practice, to me, that's a ridiculous practice in today of high-speed communication.
Well, it's a very, very interesting point you make, because certainly also you probably will recall all the way back to when Knight Ridder was a thing. I mean, they used to sell their system solely on the basis of a salesman would ring you up 2 minutes before the unemployment number and tell you the unemployment number 10 seconds before Bloomberg could. And it was always a source of some intriguing mystery as to how that always got through the network. They always said it was faster, better packet switching technology, which is probably true for all I know. But certainly the fact that the media have these things half an hour in advance, I find quite shocking. And it's not just because the media have it, it's because there's such a long tail of people in that circle that have to sign it off. So therefore, there is a lot of opportunity for the information to seep or be hacked or whatever on the way through. And that certainly does seem to me to be quite ridiculous, and we could have a more level playing field. But so going back to looking at the algos, and thank you, John T, for the question. Very interesting answer, Ira. Going back to the algos, so your view is that essentially over time, value essentially reasserts itself, and the algos often get themselves worked up into a lather, possibly because they're being fed essentially digital clickbait headlines.
100%. Yeah, you said the entire thing far better than I did, and that's right, and that's what the patience pays off. Because yes, if the trade is right, the trade is right, and a lot of times you'll see the algos. They also put in technical data, so they know where key pivot areas are or key support area or resistance areas are, and they may be reversing at that time automatically. So it just gets really interesting. And if you see the movement, especially like on when there's an ECB meeting and with a press conference, and especially with the Powell press conference, because you get the statement at 1 o'clock, I'm talking in Chicago time here,
yep.
And then at 1:30, the press conference. And the movements, the volatility in that 90-minute from beginning to end is extraordinary, absolutely extraordinary. And again, the media has to release ahead of time so they know what those numbers are. They go on lockdown until the minute, and then of course they release it. They release the whole statement, and then the media has already been able to write their stories to it. So it just needs to change. And as you say, there's a lot of things that seem to seep out. And that's a place where words are phenomenally important. We now have a whole cottage industry of parsing words in the FOMC statement.
Yes, it becomes a fascinating thing. But at the same time, I mean, generally speaking, even when there's not huge amounts of news out, the algorithms are still parsing their way through a huge number of headlines and interpreting those to their whim.
Yes, and I just at one point in my life I would complain about it. I don't mind. I just had to readjust and try to. It's almost like judo. I try to use their weight against them because I try to look for those levels because I always have a view as to what they're like. I'll have a view about the currency markets. I'll have a view on the interest rates, how it all comes together. So if it'll drive it to levels that I can find much better. When I say much better, I'm always referring to a lower risk profile entry point. So I just try to use them for that. And if the markets are really going to, and they do, as you rightly said, they come back to the fundamentals. Well, the fundamental trade will then sustain itself for as long as it's going to sustain itself. And I hope to ride it, with a portion for, if I have that view and I agree with it. I do a lot of that with the yield curves. So they'll have a staying power for a position, and I'll just use the opportunities that set themselves to establish a position. Because you see, momentum still makes a big difference as far as CTAs and hedge funds. And you have other players now too who have huge stakes in the game. These sovereign wealth funds are huge participants, and they're not just buying companies, they're actively trading. So you got the Saudi sovereign wealth fund. You have China with various sovereign wealth funds. Of course, you have the Japanese. You have a Russian sovereign wealth fund that is actively trading. These are really big players who, without doubt, have access to information that I could only dream about.
Yes, access to information, access to people that's quite off the charts. Although at the same time, I suppose some of the information they might get from central banks like the Bank of England might well not be worth the paper that it's written on in many cases, according to their recent analyses, one could argue. But nonetheless, I get your point. I mean, there is clearly a huge amount of information that goes on. And of course, the wonders of the foreign exchange market is that it's impossible to have insider dealing, at least according to the great laws of the land of the USA and the rest of the G7. So, Ira, I mean, tell us a little bit more. I mean, you have to sit there and be very patient. Does that mean that in this day and age, you're trading much less frequently than you used to?
Yes, my frequency trade. So I'll go take a walk for, I'll set what I would call some wish orders. I'll go, well, something. I try to be around when I think there's important data coming out, or I know, like tomorrow morning, I will be very attentive to the to the panel discussion coming out of Sintra, Portugal. So I try to be around for that. But the rest of the time, I just set levels. So yes, my frequency of trading is way down, but my success, my losses due to just being bored are diminished dramatically.
Right.
That's a floor trader's curse, because you always feel you have to be trading, but that becomes really silly. Let them do what they want to do. We've seen here. I'm sitting there trading the gold market, and we've seen movements. Here you have a $20 move in the gold market today on nothing.
Yes.
You had a little bit of data, meaningless data, and they went this way, they went that way. But I'm really keyed in, and I'm watching very closely about any news out of Japan, because it's really just. And everybody says, the central banks then get focused on, well, are financial conditions loose or are they tight? Well, they have finally gotten away from just looking at equity markets. Because if equity markets are going up, it doesn't mean, as we saw basically in March and April, by the way, if equity markets are going up, it doesn't mean that financial conditions, that's not the definition of loose financial conditions, as we saw. Because the equity markets were going up, and then all of a sudden we saw 4 major banks wind up on the wrong side of the ledger. So financial conditions are without question tightening, even in the face of rising equity markets. But I would pose this question to Jerome Powell and to Christine Lagarde. Isn't, in fact, Japan's actions of not moving interest rates feeding a liquidity pool available for global assets that keep global assets elevated. And even the ECB came out 3 weeks ago with a paper that said that if Japan were to normalize interest rates, it may in fact disrupt the global bond markets. That's from the ECB.
Mm-hmm.
So there are some, thoughts to this. So, I'm really interested in what's going on there. And of course, the weakening yen or the soft yen is leading to a soft yuan, renminbi.
Yep.
Because the Chinese have all of a sudden, kind of let the renminbi go. And I chart the yen yuan chart. It's a very important chart to me, politically and economically, because the Chinese have told us so. I go back to 1998. So it's very, and we're at almost all-time highs of the yuan against the yen, which makes them none too happy for the moment. So there's a lot of things in play here. And again, the yen it may all be going on with a nod and a wink from the rest of the G7, because you could see Germany turning down. And I made this comment to somebody: Germany and Japan are direct competitors. You want to see where Germany, they're both high-end quality manufacturers of automobiles, optics, machine tools. They compete. Well, the yen has weakened over the last 18, 19 months, 30% against the euro. That's a phenomenal advantage to the Japanese. Phenomenal.
And it's a phenomenal advantage to the Japanese. And indeed, also, it's quite fascinating because, of course, part of the whole rationale, it seems, for Germany wanting to be in the euro in the first place was to profit from all those traditionally weak currency nations like the Italians and the Greeks and so on. And things are now turning around against them. It's got to be obviously causing a problem, particularly as Germany's buying so much energy to replace its hideous bet on Russian energy dependence, which has cost it absolutely dearly. It's fascinating, though. I mean, we're having this conversation, really interesting stuff about the yen and so on. And yet you compare this to, say, 3 decades ago. I mean, just about 30 years ago, we had the putsch overthrowing Mikhail Gorbachev, the first one. Mm-hmm. And I mean, markets were transfixed by nothing else for the entirety of a week or more. And yet this time around, you've got effectively a coup against Putin. And it shows how much the world has changed, because we're barely even talking about it in our day-to-day trading environment.
You're right. And I know exactly where I was. I was at a wedding on a boat. And how inside the harbor lines of Chicago, that's where it was one of those big boats. It was my wife's cousin getting married. And I saw it come across on my telerate machine, which I carried. And I was close enough to be able to get a signal. And I'm going, oh, my God. And I go, I got to get off the boat. He says, you can't get off the boat. I said, oh, no, I can swim. There's no question. I'm close enough to shore. She says, you're not swimming. So, yes, I remember that night. It was a Sunday night in August. Oh, boy. Right. And yesterday I must have gotten, or I'm sorry, on Sunday, my mailbox was full of stories about what was going on. And I sent everybody who I cared to send to, I said, we don't know anything yet. Be really careful with this. These things don't go on. This is Putin you're talking about. So we don't know, and it's going to take a while to be able to read through this. So the market was really mature in the way it acted. But I think the markets, because of the algos, are better at certain things. And that's not overreacting, because their ability to siphon through news and the sort is that much better than, because rather than just running with the one headline that we used to run with off of Telerate, or as you would say, Bridge News or Reuters. They are better than that today.
Fascinating, really fascinating altogether. And I suppose that brings us to an appropriate moment where I'm going to give you a slight rest, Ira, because you've been talking so much. And let's go to the book of the week, ladies and gentlemen. As you know, we've been running a book of the week for the course of the last few weeks in response to readers' queries. That initially comes out in the weekend edition of Exchange Invest. That's more of a macro read and it's completely free. You can sign up for EI Weekend at the website exchangeinvest.com. And then it's repeated here on this live stream, as well as being mentioned during the week in Exchange Invest, which is, of course, the exchange of information for all of those of you who want to keep up with everything that's happening in the business of bourses. So this week's book was written by a two-time guest on IPO-VID. He was on episodes 36 and 43. The man who is self-described as Crypto Dad, Christopher Giancarlo, the former chairman, the 13th chairman of the United States Commodity Futures Trading Commission. And while he was there, he was pushing for the agency to recognize the digitization of markets. Crypto Dad argues that the next digital wave will be the coming Internet of Value, where cryptocurrencies will do what the Internet of Information did to immaterial things, make them accessible, distributable, and movable instantly across the globe. That's this week's Book of the Week. It's published by Wiley's, Crypto Dad by Christopher Giancarlo, former chairman of the CFTC. Now that leads us to bring back nicely to Ira, because I think we've got the opportunity to then wonder. I mean, you've been a man who's been heavily involved in the liberalization of cryptocurrencies, or at least the trading of the liberalization of liberalization of fiat currencies, rather. What do you think about this whole cryptocurrency business?
Well, I'm a real idiot in the world of virtual, because when I was working with a group of guys, in fact, I still work with them, back in 2011, 12, and there were a couple people who traded out of the room who were wildly bullish about Bitcoin. That's when it was trading $20, $30, $40. And then it got up to 1,000. And we would talk about it, and they would say, I say, I understand it. And I'm more, and in fact, I've made an investment in a blockchain company who deals in Forex called Ninth Gear, Marianne Morrow, who put it together. So I always was interested in the blockchain end of it. So I thought the problem with a virtual currency is that, I read Article 1, Section 8 of the U.S. Constitution about who has the right to print money or mint money. And of course, it's Congress, it's the United States government. And I was always fearful that they could shut it down at any time. If they could ever say, well, there was a terrorist attack that was paid for via Bitcoin, it would be over. So that kind of scared me, and I stayed off of it, but I watch it. And when the exchange was going to list, a couple of people called me in to ask me my opinion. I think this was in 2015 or 16. And I said, well, I can't really tell you about what risk you're taking on. But if your business, and I know your business is, and I applaud the business you're in, which is risk management, you have to list Bitcoin contract. And they did. I mean, they didn't, I was not the catalyst for it. They just wanted, as somebody who trades all around the world, what I thought about it. And I think it was still the right move. And it gave Bitcoin that much more credibility, even though it's not a deliverable, but it does give you hedging ability and people can play it. So, and again, the margin on it is high enough that it took some of the ridiculousness out of it, which was good for the exchange. So where the virtual currencies go, I really don't know. I have missed this boat, but I watch it because it has to play a part in the way that I see the world at any one time. And now we're on a pretty good move. Of recent late, we're back to 31,500 on Bitcoin. So it has standing, and it has legs, and it has credibility amongst a certain investment crowd. And now we have, BlackRock is getting involved in it, which drove the recent rally, because if they get behind it, that's a monster. So it works.
Interesting, very interesting viewpoint, and interesting to hear you, like Jimmy Olaf, very interested in the blockchain per se, and that side of the business as being vitally important. So if we go back to, where you're trading these days and what you're trading, you mentioned the fact you've been trading gold recently, etc. Do you find that as an electronic trader sitting in Scottsdale, Arizona, that gives you the opportunity to roam more across the whole global macro picture?
Well, I was always doing that, Patrick. So the world has just kind of come to me, but I had no idea how big this could possibly be and how much money could, people would tell me, I managed hedge funds 3 times. and fairly well. But I said, well, I can't grow enough. I don't want to grow that big because I don't want to trade that big. It'll change everything. So I would send the money back. And they said, no, don't send it back. We want you. I go, no, I can't trade that big. I really had a great opportunity with some of the best in the business going back to the mid 80s. I started a hedge fund, and I grew from up to $7.5 million, which I thought was an incredible amount of money. And I was trading and actually had a pretty good year in 86, 87. And then somebody wanted to triple us who had given us money. I said, no, I can't trade that big. Oh, you could do it. I go, no. So I sent all the money back, and that took care of that one. And then I went back into it in 92, 93, grew it again. And I just, so I keep trading and I'm doing everything the same. I always did it. But I'm amazed at how much money came into this sector. I mean, it amazes me every day.
Well, it's amazing how much money came in, and also the sheer depth of the markets. Because, I mean, when you're talking about 1986, 1987, relatively small clips could start moving most every futures and options market without much difficulty. Whereas nowadays, I mean, some of these electronic markets, you can manage to look at them and they can be hundreds of contracts up, and you can simply lose thousands of contracts into the market. I mean, execute thousands of contracts into the market and make barely a ripple on what's going on, which is amazing.
It is amazing, the depth that the market, and I realized it even in the early 90s, because the game was up. Nobody wanted to know who was even doing anything anymore. It used to be everybody wanted to know, whoa, who's doing that? Who's doing, so it doesn't even matter, especially, and I knew better because in the currency markets, even though we traded everything, commodities, bonds, equities, but in the currency markets, the depth of the market, as they always they talk about 5 to 6 trillion. I always thought that number was nonsense because that includes every swap, every things that I could never trade at, and I used to get on the exchange and said, don't use that number because you're not trading those vehicles. You're not trading, certain types of dollar swaps. You're not. So why would you put that minimalizes you? Because when it really looks at what you're trading speculatively, Swiss francs, Japanese yen, British pounds, Canadian dollar, you have much greater percentage of the market than you're letting people really know by citing that 5 trillion. I always thought that was a joke, and when I would sit down with banks who I would do business, especially when I worked with my friend Owen Brown, he ran Solaris Capital back in 06 and 07. So I worked with him and I would sit with the banks and I go, you always tell me it's a $5 trillion market until I need a market on 100 million. It's unbelievable to me. And they didn't like hearing it, but they knew what I was talking about.
Well, it's quite fascinating because, yes, the numbers that have been bandied about over the years were incredible. But at the same time, the sheer depth and size of markets these days is incredible. But I have to say, I mean, I applaud you because you were global macro trading a long time before it was easy to get the data. I mean, that's the thing I think is very tricky. I mean, in this day and age, thanks to the interweb and all manner of other things, you can find out incredible things. You can read the same newspapers. You can read the South China Morning Post to find out what's going on in Hong Kong, and you can read Nikkei Daily in English, even if you want to, or you can indeed read their subsidiary, the Financial Times. But, those days when you first started out, actually extracting the information was darn difficult until some guy philosophically decided to be nice to you and faxed you the story from the Star in Malaysia that morning or something.
Well, you know what? Because I had a pretty good reputation at the exchange, so I was able to make contacts in Asia. It used to drive my wife crazy when the phone would ring from Hong Kong at 3 a.m. And everybody wanted to trade some information, and I built up a pretty good network of people who wanted to talk to me, not just what was going on, but they wanted to talk about how I saw the markets and what I saw coming out of Chicago. Chicago really developed a big, giant footprint, and we had a reputation of being a lot more right than wrong, and because of the types of people who came to trade through the exchanges and who wound up doing business there. So, and the traders, nobody's better than one who's managing your own money. When you got skin in the game, you teach yourself to be that much better. And so a lot of bank traders around the world would seek to develop relationships, not for anything nefarious, just to talk about things. So when I'd go to New York, you'd sit and have a drink with them and develop those relationships. So those were very important relationships. And then I always had two clerks that would really run my news stories for me, and they would hang around at the writer's machine and look for things. And when numbers would come out, and if I wanted them to run bond orders. So I always had that available to me because I knew how important it was. And then when I'd go home after I'd get the kids to bed, and I would peruse what I think was important for the next day, was CPI data, which nobody even really, CPI was maybe important for bond traders, but for currency traders, probably the biggest data was unemployment, of course, and the trade numbers. But then by the late 80s, early 90s, nobody even cared about the trade numbers anymore. Yeah. So you always saw a shift in it, and I understood that. Things are really dynamic, and I approach the markets in a dynamic sense. And when I teach, and I'll get invited to this lecture at different universities through people who know me, and I always said, if you're working on static models, you can't make this work. You have to be far more dynamic in the way that you approach your markets. And that's my hats off to the algorithms, because they've learned to be dynamic. They were building static models and they got run over a few times because they weren't dynamic enough in the way that they would correlate the data when markets were moving. So they've gotten really good at that, which has slowed me down even more. But I still read everything, and I still poke my fingers. Like last week, in a preposterous thing, or it was actually 12 days ago, the U.S. Treasury Department came out with its watch list of currency manipulators, and nobody was on it except Switzerland. Now, I started laughing, the fact that they were watching Switzerland. The Swiss franc just made all-time highs against the Japanese yen on the day they released that. I go, so how can you name the Swiss as a currency manipulator? If anything, why aren't you looking at the Japanese? Yeah. All-time highs. I'm not talking about 1 week high, a year high, 10-year high, all-time highs. We're going higher. The euro yen, we're at the highest levels we've seen. In fact, we're touching it today, going back to this will be a good time for you, September of 2008. Mm-hmm. So this is quite a lot. There's a lot of things going on, and yet the Treasury Department. I said, if I was a college professor, I would expect my sophomore students to be able to come up with something better than that. I found it just.
It's incredible to think here we are 38 years on, nearly 40 years on, and maybe what we need is a new Plaza Accord, because everybody was very vexed about the yen at that time, weren't they, Ira?
And by design.
By design. Yeah.
The yen, in fact, I'm just reading Chris Miller's The Chip Wars, and they talk about it. There was a lot done to promote Japan, and I'm thinking that they may be playing with the same thing, and the G7 is willing to go along with it because they're trying to reshore to Japan, because Japan had howled itself out because we know the yen was far too strong for 10 years. Yeah. Up until Abe of 2020, when he invoked upon the 3 arrows program, and they moved to weaken the yen, and they did it with the okay of the G7. But the yen is awfully, awfully weak here. And I know the Germans can be none too happy because they're just trying to really, everybody's trying to come out of COVID. And listen, as much as Germany and Japan compete around the globe, but they especially compete in China. And right. I did a podcast a while ago in fact, it was probably 18 months ago with Louis Gavet from GavKel. And I'm very fond of GavKel, but especially Louis. And we did it. And Louis brought up then that, because we were talking about the yen, and he said, you could probably look for the yen to remain weak, because it seems like China would rather have the Japanese right now in China than they have the Europeans. And we know how big investments, Siemens was out last week saying, well, we're not decoupling and we're not de-risking from China. We're going in more and more because they have huge investments. Volkswagen, huge investments. BMW, Mercedes, huge investments. So interesting things, and nobody's paying attention to it, but because my analysis always starts with currencies that leads to debt, that leads to everything else. So I always begin there and like to see where the world is. And I'm still working at this, Patrick. This is 14 hours. People say, oh, you're retired. I said, no. First of all, my wife won't let me retire because it would be a very bad thing. And I'm just not geared for it. And I've got, as you say, 40. I've been doing this really for 50 years, including my academic work. So you just can't walk away from it. And it's not something that I have to sell. Like I can't just say, well, here's the keys to my brain. But you can buy my work. Yeah. I'm happy to sit and consult with anybody. And I cover the globe in a very dynamic fashion, I think.
Well, on that dynamic macro note, let me just ask you one final question. It's the traditional one. Let me delve into your brain, Ira, and say, where do you believe the capital market revolution goes next?
Well, certainly crypto will have a say in there. I think it will be, because I'm a big believer, and you can talk about my self-interest, but my self-interest emanates from the fact that I see this, is that they're going to change the way the entire fee structure works in the financial world. And that's what blockchain will be good at. Because, Wall Street makes a phenomenal amount of money on fees, lending stocks. As Marianne Morrow will tell you, it's preposterous that spot currency delivery is a 2-day affair. That's just so beyond the pale. As in, we talked about the media changing, because the fact that there's early release of all this data to the media is, to me, just wrong. So these are changes that are really taking place. But I think the way that fees are done are going to change dramatically, and that'll force Wall Street and others who operate that to change. Because if I can hold my equities in a blockchain ledger which is coded with my biometrics, I don't have to let the OCC or the DTCC, hold it. And therefore, if I want to lend my stock, I'll lend my stock and make the money. Because, it used to be, Patrick, we're old enough that they used to send you the stock certificate and you'd put it in your vault.
Yep.
Now it's held at the DTC, and it's not even held in your name. It's held in street name. It gets lent, and they're making a fortune. And why should this be allowed to remain in place? So it'll change. And I think it's one of the big parts of the revolution, because once you break that fee structure, then a lot of other things break with it, by the way.
And on that note, Ira Harris, patience is a virtue. I have to say, I wish we could spend another hour talking about this, because I've been patiently listening and it's been absolutely excellent altogether on a macro basis. Thank you very much for joining the show today. Thank you very much to our contributors, Peter Secon and John T. Really appreciate your input along the way. Let me also say thank you very much to the production team of Hermina, Jamil, and Fernando. Coming next week, we're going to have Scott Shellady. We're going to be chewing the cud, the market cud, with the cow guy. That should be an entertaining conversation with another old hand from the Chicago floors of yore. My name is Patrick L. Young. Thank you very much once again, Ira Harris, for being a great guest on this IPO vid. We'll be back next week. I wish you all a great week in blockchain, life, and markets.